You want it? We have it. The hottest mortgage and real estate strategy broadcast in the nation. A Smarter Way Home with your host, Danielle Boote and Victor Bals. 50 years combined experience, ranked in the top 1% in the nation for home loan originations 2020. Promise to expand your knowledge, utilizing creative mortgage financing and home buying strategies. Build a bridge for a better quality of life. Get your brain cells firing for a smarter way home. And welcome to another episode of A Smarter Way Home. Modern mortgage strategies for real estate professionals and consumers alike. Today's show is going to be kind of interesting. We got some stuff to talk about, but first of all, I want to introduce my co-hostess with the mostest, loan officer extraordinaire, coming from Dallas, Texas, across the country here, Mrs. Danielle Boote. Hello.
Good morning, Victor. How are you?
All righty. And so how's the weather there in Dallas here today?
Sunny and very nice. They got into the high 70s yesterday.
Wow, and that's not bad for March. And here in Detroit, it is about 17 degrees, but this weekend we're supposed to go up to 70. So pre-spring is coming about here.
Well,
and
anyway,
so this spring,
that means a lot for the real estate market.
It does mean a lot for the real estate because typically our spring buying season is started, and it already somewhat has started. And let's talk about this real estate market today, Danielle. We have a huge inventory issue, and we see potential home buyers trying to put offers in, and they're just getting kicked to the curb with these well-qualified, paying appraisal guarantees, paying buyers and listing agent commissions, paying transfer taxes. It just seems crazy. What's your stake on this market here? What's going on?
Well, from my vantage point, we have had a housing shortage for a couple of years. It's not ebbing anytime soon. And we have talked previously about the millennial homebuyers being 35% of the buying market, and they're not selling a home. They're trying to buy their first home, which means they're not replacing a house on inventory. So when you look at the demographics of this 45 million millennials, this housing shortage is going to continue. It does seem to be more problematic this season. And I have said, we had our office meeting earlier this week. One of the things we discussed was this was the most traditional real estate market that we have seen in Michigan in at least 10 years. And when we talk about a traditional market, Michigan typically slows down in the winter. No one wants to list their house when it's cold and it's frozen outside and there's snow and there's salt everywhere. So we typically will see a slowdown, from December into January, February, and into March. It certainly, I think, is more pronounced this year. We've had a kind of a longer spell of cold weather. We've had a little bit more snow, seasonally than years past. And there's a lot of buyers that didn't find houses last year that are still hoping that they'll find a place.
Well, and we talk about the market, the traditional market. I'm concerned of an extreme seller's market, which I feel we are in. And when we compare that to an extreme buyer's market, like in 2008 and 2009, when scrupulous lending had driven the economy down, we lost 40% in values on our properties, our 401ks, and it drove the country into the greatest recession since 1929, the Great Depression. And back in those days, there was ample supply of housing and not enough buyers, and we were seeing a typical offer go in that, Mr. Seller, I will buy your home contingent on me selling my current home. And that was traditional. We would see that all the time, whereas now it is a complete 180-degree flip-flop that there is no inventory, and most sellers are not even considering an offer coming in from a buyer contingent on that buyer selling their current home. Are you seeing that? Are you feeling those extremes?
Absolutely. Absolutely. The other thing we've seen with sellers is there's a lot of sellers that are in the position, for instance, that they want to downsize. They may have lived in their home for a very long time. They very well are retired. So, they're on a fixed income. They've got to really calculate out how they're going to handle moving into their next home, and they're afraid to list their house for sale. That house being listed would be very important to our local real estate market, because the buyers would be waiting for that house to be listed. But until that seller has a comfort level to say, here's where I'm going, and I'm comfortable putting my house on the market, it's almost like a stalemate in chess,
Yeah,
right?
a
We've got
stalemate.
buyers, we've got sellers. How do we get them together to make this a win-win situation for buyers and sellers?
So let's talk about that comment you just made regarding that potential seller who wants to downsize. Are they fearful for selling their home because they won't be able to find another suitable dwelling because of the lack of inventory?
Absolutely.
Okay, and that's creating
Absolutely.
this
Nobody wants to
stalemate.
be homeless. Yeah.
Nobody wants to be homeless. And let's talk a little bit about, first-time home buyers and then second-time home buyers, like the person you just mentioned there. First-time home buyers, from my perspective, they have a case of the wants. They want to buy a house. They want to put littler down. They want the pride of home ownership. They want the tax benefits. It's a want, want, want. It's like saying, I want to lose 20 pounds. I want to make $1 million. I want a new car. But then there's the needs. In order to do a want, you got to have the needs. You need to exercise. You need to eat right. So we have our first-time buyers almost with a case of the wants, but then we have our second-time home buyers, our current homeowners. They have a case of the needs, because our second-time home buyers, they buy for different reasons. They need to relocate. They need to downsize. They need to upsize. They need to potentially sell because of a pending divorce situation, or they need to sell because of another type life-changing event. In that stalemate, there's no available inventory, again, creating this stalemate. What are your
Well, I
thoughts
think,
on that?
yeah, I think the move up or move down buyer is less likely to settle. A first time home buyer is going to be very excited, and their needs list is going to be shorter, or their wants list is going to be shorter, or they're going to be more flexible. They just want to become homeowners. We all have to start somewhere. When you're looking at a buyer that's making a different decision in life, for instance, if you have somebody that's retired and they want a condo, they're not likely going to buy a single family home because they really need a condo, and they might be looking for a bigger condo that has a 2-car garage or a basement or something of that nature that gives them the amenities that they had in their home, just in a lower maintenance package. They're not going to settle for what doesn't work for them. With
Right.
good reason.
Right. And we've also talked about, we discussed inventory, and you brought up a great point. When a first time home buyer comes onto the market, they take one out of the inventory,
Hmm.
right? So we have less supply. When a current home owner, when they sell their home, they put one on the inventory, and when they go buy another one, they take one off the out of the inventory. And recent data is stating that with all these millennials, what is it, like 5 point something million coming into, or these first time home buyers, about 5 million a year
And so,
entering the home buying market, and yet the building industry is only building about 1 million homes. So this shortage, we're 4 million short a year. This is going to continue to go on until we
right.
get more supply.
Right. And nationwide, we've talked to the president of the Michigan Builders Association a few weeks back. This housing shortage is, from a building perspective, will probably continue for a solid 10 years. The builders are going to be busy. They're going to build as fast as they can, but we have supply chain issues, we have manpower issues, there are city, state, and county regulation issues that make the building process more expensive and slow down.
Right. And let's talk about the financing issues, because back in 08, 09, the small builder was able to get spec money.
Mhm.
Right, the banks were offering spec money for the builder that may build 2, 3, 4 homes a year. And it seems like all of that money is gone. There's only the big builders, such as the Pulte's and these big operations, able to get financing. So it's leaving our small hometown builders out of the equation unless a client can go get a construction loan. And then we need to find land and get through all the municipalities. And that may build more supply. But now we talk about affordable housing. One, there's available housing, but then
Yeah.
is there affordable housing?
Right.
What's
Yeah.
your state on that?
Well, it definitely is an interesting dynamic. Livingston County in and of itself is kind of unique because we were a very rural community up until the 1980s and the 1990s. And when we started to build out here, there weren't, for the most part, massive tracts of subdivisions. People that came out here, this was their dream to get out to the country. And we have very few areas that have what you might consider affordable housing because it wasn't built that way. And this goes back 40 years. You can't redo what happened 40 years ago. When you look at the Detroit market, Livonia, Westland, Farmington, Royal Oak, all of those areas were built more kind of systematically. Right? They cleared land and they were going to build ranch homes in Livonia. Right? How many neighborhoods do we
We
have?
had one when I was growing up as a kid. Yeah.
Our first house in Westland was, a cute little ranch like that. But the whole neighborhood there were 3 floor plans in the whole neighborhood, and that's what the builder built.
3-bedroom brick ranch with a 2-car detached garage. Yeah.
Yes.
Back in the day.
Yeah, exactly. So, the challenge with Livingston County, I think, from an affordability standpoint, is our homes aren't that small. There are some pockets where you can find what one would consider affordable housing. Now, on the flip side, I think what's really important for consumers to keep in mind with Livingston County is our tax rate is the lowest in the state of Michigan, hands down, year after year after year. So even though our house prices might be a little higher than, let's say, the Metro Detroit area, because our taxes are lower, you still can have a payment in many cases in the range that you're looking for. You need to understand the tax differences and how that impacts what your monthly payment's going to be so that you can make a wise decision.
So there's a little bit of a competitive edge by people buying Livingston County because of the lower taxation.
Yes, yeah. And, I know I have shared this with you in the past, but I have 2 older daughters that have homes. One's in Howell. The other one is now in West Bloomfield on the border of Farmington Hills. And when our daughter moved to Oakland County, that's where her job was. She was shocked that, she was like, okay, this is what my payment is. These are what my taxes are going to be. Her first house was in Berkeley, which is a city area. And her sister, a few years later, bought a house. And she actually got mad at me and said, Mom, how could you have them afford a $235,000 house for their first house? How can they afford that? And I said, well, here's what you don't understand. I said, their payment is not that much different from yours, even though you purchased a much cheaper home because of the taxes. And then I explained to her how Livingston County worked and the whole 9 yards. And she was shocked. I said, you don't know what you don't know. But, what looks expensive, and people judge, right? It's easy to say, oh, a $250,000 house, how can you afford that? Or a $350,000 house. Well, it all boils down to what somebody's house payment is. So buyers right now, whether they're first-time home buyers, move-up buyers, really need to understand the numbers so that they can make a wise decision for them.
Absolutely. And you brought up a couple great points there. Is one, you are not approved for a mortgage amount. You are approved for a payment amount. We don't care if you buy the Taj Mahal, as long as the payment does not go over X amount. And that's what you qualify for.
Exactly. And that's what most people are worried about living with, is what their payment is.
What's the house payment? You brought up the other point that your daughter moved to Oakland County because where she works. So As we come back here to Livingston County, there's a concern there about our local infrastructure here. So people like to live where they work. And if we're looking at home affordability in Livingston County, are we not pushing people away from working in Livingston County because the housing is getting so expensive and those people have to travel too far from Livingston County because they're living in other areas, but they would love to come to Livingston County, but it's just getting too pricey? Or is this all over the place?
First of all, I think that's all over the place. And it really depends on where you are in the income scale. Okay. If I'm not going to say that it isn't going to be harder for first-time homebuyers in the next few years. Although wages are going up, we're also dealing with inflation, which is something we have not seen at these levels in 40 years in this country. So really, when you look at the fact that first-time homebuyers are 40 and under, they don't understand inflation. They can't comprehend what happened to interest rates in the 1980s when they were 14, 16, 18% for a mortgage. Okay. They can't even comprehend that, but I see buyers. Typically, we will, of course, get single home buyers. I'm not saying we don't. The majority of home buyers seem to be in a couple situation, where there's two incomes in the household. And I see that these buyers are buying homes with kind of one income. Most buyers really are not stretching themselves to say, oh, we're buying at the top end of the market. I'm not saying it doesn't occasionally happen if somebody knows that their income's going up or whatever, but most people are only buying on one income. So when you look at that, some of the buyers' misconceptions, in my personal opinion, is that they're focused on a number and not looking at market conditions, interest rates, to be able to make a decision. Like, I had a buyer that called me last week and he was happy that he didn't buy last year. Okay. But now house prices have gone up 15% and interest rates have gone up a percent. And he just thinks he's going to stay in this little bubble. And, if it's not realistic, it might not work. I'm not saying he's not going to get lucky along the way, but, from an affordability standpoint, you have to look at, again, where you are in the income scale. Right. With wages going up and things of that nature, there are opportunities for people out there if they're realistic.
Well, let's talk about the inflationary jitters that we're seeing across the country here, but let's boil it down to a local level. Excuse me. I pulled a report from the National Association of Realtors, and in the state of Michigan, the typical home sale drives an additional $72,000 into the state and local economy for a home sale. Meaning, this could be real estate commissions, title company fees they bring in, moving companies, appliance companies, the guy that makes the cardboard box for the moving company, well and septic people, home inspectors, appraisers. There's a huge amount of money that is generated from that typical sale. And if we don't have these sales, us people who live in the community, in the state, who I guess share in this revenue. Now, we don't have the funds to go to the local restaurants, pubs, shopping, and to spend that money to get the economy going or keep it running there. What is your thoughts on that?
Well, that is a long known fact that the purchase or the sale of a home absolutely is an economic driver in a local and state and even to a federal economy. But certainly it's very, very strong local. So, real estate and the sale of real estate is extremely important to a local economy. So, and that's one reason, we know it's important, and that's why we're hoping that it does kick into gear here. Now, we are very busy with pre-approvals right now. I would say in the last 2 weeks, we've gotten much, much busier with pre-approvals. So the buyers are literally getting their running shoes on, standing at the starting line, getting ready to roll as the listings increase. But when you look at the Livingston County data, did you pull that data today,
Well,
Vic, from
I
Elkhart?
was looking at some stats there on one of the realtor posts there that the average home sale now in Livingston County is up to 371,000, up from 343 just last month. So these prices are continuing to go up. What were you referring to, Danielle?
Well, I saw the Elkhart data for
Hmm.
February, I think it was, on how many homes were listed. And we
Hmm.
had, I think, I could be wrong here, but I thought it was 187 homes listed in Livingston County in February. That is 6% lower than it was a year ago. And every single one of those homes sold.
Absolutely. Again,
So
tightening the
pretty
inventory.
much as a seller, you're guaranteed price it, get it on the market, and it's going to sell.
Yeah, but my concern is where are these sellers going because they're selling at a high dollar, but now they're buying at a high dollar. It's almost, let's call it a transfer of equity. They just want to
Mhm.
get into their location. But how do we free up more inventory, Danielle, out there? What is the secret out there? Are there any
Well,
secrets?
I think it's important for a seller, somebody that needs to sell a house, to sit down with a loan officer and really do a deep dive into what their options are. What will they qualify for? Okay. What is the minimum amount that we can get them into a house for? What would their goal be if when their house sells? And is there a plan that we can come up with together that will allow them to buy before they sell?
Right. So a
You
buy
know,
non-contingent of
buy
selling their current home.
non-contingent on the sale of your home. And you can do it to be prepared. So many sellers will start looking, will pre-approve them for instance, 5% down conventional, because they have liquid assets to be able to do
Hmm.
that. We can get creative with assets even. Um, we pre-approve them for 5% down, get them out there looking, knowing full well that they're going to list their house for sale as soon as they're in contract.
Right.
Most of the time, we have even had sellers be so prepared that the listing papers are ready to go with their realtor, and even the home has been photographed. So as
Hmm.
soon as they're in contract, they can be listed within a couple of days, get their home under contract. And many times, there's not even a delay in closing both houses. If you've got a great realtor working for you, they will help coordinate between all parties on all sides of this transaction to close those homes potentially on the same day. So you're writing a legitimate offer to a seller, not contingent on your home. We can always have you put more money down. So let's say it all falls into place and you're going to close both properties the same day. You could call me and say, hey, Danielle, I want to put 20% down, not 5% down. Perfect. That's a keystroke in our system. And we can, change your loan very quickly. But if we got you approved for the higher amount, you're approved for anything under
Right.
that.
Right.
So
Right.
that is one of the creative options. There are sometimes bridge loans. I have seen people take home equity loans prior, or having a home equity loan, use that to leverage for the down payment. A lot of these sellers right now own their homes free and clear, particularly people that are a little older and retired. They're more established. So they may have some limitations on what they can do because of being on a retirement type income. But we have to look at the whole picture. You need to get in and talk to a loan officer to figure out, let's come up with plan A, plan B, plan C, so that you are prepared. Many times, particularly established clients, they just want the realtors to start showing them homes.
Hmm.
And they don't understand, well, I liked that condo. Why did they sell it to somebody else? Well, because you didn't even have a pre approval letter. You didn't
Right.
have a game plan. There was no ABC. There was not even an A. You hate to say it. I don't understand why the realtors are really wasting their time showing people homes when
Yep.
the potential client doesn't even have their a financing strategy in play.
Well, let's talk about that person who owns their home free or clear, has a lot of equity. They may contact a realtor saying, "Don't worry, I'm good, man. My house is paid for, free and clear. I'm good." But still, if there's
Right.
no strategy in place, that's going to be null and void in this competitive market. And let's talk about that person that's free and clear, but all their equity maybe all their equities tied
All the
up in their home.
cash.
They may not have a lot of savings. So that's a perfect opportunity for them to sit down with their local loan officer and describe and say, why don't we go get you a home equity line of credit? In most cases, those are no cost. It's basically a checkbook on your house for 50, 100,000, whatever you may need. So you can use that cash to go in, make an offer, non-contingent of you selling your home. We use that equity line for all your down payment and closing costs, close on that purchase, and then list and sell your home top dollar and then pay off that equity loan. We've seen those strategies work quite well, but it's about the client getting with a local lender, no matter how qualified you are, to have that lender explain the winning strategies in a seller's market.
Exactly. And one of the questions that we get frequently is, what is a bridge loan? And does it work for everybody? So what a bridge loan is it is short-term financing on your existing home. There's a couple of ways it can happen, and I'm not going to go into detail on that today because it's more.
Give us the 10-cent story, though, Danielle.
Well, it's basically a loan bridging the equity from your old house to your new house, okay? Mm-hmm. And there's a couple ways it can be structured. Sometimes it's structured where they pay off your existing mortgage, bridge the equity, okay? Then when you sell your house, you pay down your new mortgage. Or it can be a short-term, like interim loan where you don't pay off your existing mortgage, and then you kind of have a first and a second, and it's paid off at closing. But I had somebody recently contact me who is retired. His current home is free and clear, and he wants to buy first and then sell. He's been in his home for 48 years. It's going to take him a while to, have an estate sale, things of that nature. So he doesn't want the stress. He wants to be able to get settled and then go. Well, he inquired about a bridge loan and was told that he didn't qualify because he only had a Social Security check. Now, not saying that only a Social Security check is necessarily a bad thing, but the banking regulations on other types of loans are different than first mortgages. So he came to me a little frustrated going, Danielle, I have my Social Security check and he has assets. Plus, he's got this house free and clear. Mm-hmm. So when I sat down with him and looked at all the details, I was able to come up with a plan to get him to qualify for a mortgage, use the funds he has to buy non-contingent so he can hopefully find the condo. In fact, he did go into contract this week on a condo, which is really very quickly since he started looking. But when he inquired about a bridge loan situation, that particular lender just said, oh, sorry, sir, you don't qualify. They can't look outside the box and look at his whole financial picture, apparently. So if you get a no, don't take necessarily that no as an answer. You need a second opinion, and let's look at a bigger strategic plan that we can come up with and get you qualified for a mortgage. You can pay it down later. All of those things, this gentleman knows that it could take him 6 months to a year to get his house ready for the market. He's got a project in front of him. So he said, nope, Danielle, I might not have this mortgage for 30 years, but he goes, I'll have it for at least a year, and it will help him make that next step, into where his future is going.
So you offered him a Band-Aid to get to stop the bleeding until we could put the stitches in with the overall long-term plan for over that 1 year.
Right, which means we will free up a house that will hit the market probably in the next 6 months. That will be perfect for many first-time home buyers.
A lot of people that are retired and maybe have fixed income, Social Security, maybe a pension and that have a lot of assets, don't understand that we can actually take those assets they have in the bank and create income streams from them for qualifying purposes. Could you elaborate a bit on that, please?
Yeah, that's a very important guideline to understand. It does not work for all borrowers, but it works particularly well for retired borrowers that are on a fixed income but have assets. According to the IRS guidelines, when you are 70 and a half, you are required to take a minimum distribution from your retirement assets. And when you pull money out of those tax-free accounts, Some cases, it is taxable income, but it is income that we can document. So sometimes it's a matter of investigating a client's financial portfolio and saying, are you taking withdrawals from your assets? Many times they say, oh, yes, they take $20,000 a year, $30,000 a year. That is documentable income as long as it is likely to continue for 3 years.
So,
we have
Nick,
to see.
go ahead, please.
We just have to see the asset base high enough that whatever they're drawing down will continue for at least 3 years. It's not hard to document. We need a couple months worth of bank statements and a letter from their financial advisor just stating that, hey, confirming that they're taking this money, it's likely to continue for 3 years, and we can use that as qualifiable income.
Okay, you brought up the fact that that particular customer says, "Oh, I can draw $30,000 a year." Well, that's $2,500 a month that we use as qualifying income to offset any debts. And many of these individuals could set up the income, or we can actually calculate the income stream that will be needed to qualify to, I guess, take them to the promised land and move on to their next venture and get them into that new home.
Exactly. I mean, most clients that are in that demographic, they don't have a lot of debt. They might have a small mortgage, if that at all. They typically have a car payment. All other debts are paid
And they
monthly.
typically don't need much income. That's why they keep all their assets away. So
Correct.
in this seller's market, these creative strategies can actually give them a winning solution to compete
Yes.
and have them move on to the next chapter of their life.
Exactly. And that's just a really important part of freeing up inventory in the market. And I have had, here's something that I have offered to some of my realtor partners. They will have clients that know that they're going to pay cash for a house and haven't figured out how they're going to do it. I've actually counseled their clients to say, okay, here's your options. You got ABC, which one makes sense, and go from there. We can potentially give somebody a pre-approval letter that doesn't even ultimately need a mortgage, and occasionally that happens. And, if it's somebody that I know and trust, and I don't have a problem doing that for them occasionally, saying, okay, let's help these people out to give them multiple options and then see how all the dominoes fall in line. And then they can decide, do they need a mortgage? Do they not need a mortgage, or do they need a small mortgage?
Yeah, absolutely. You brought up a point about paying cash.
Mm-hmm.
We brought up points about people have assets. Let's bring up another point where these first-time home buyers, for example, have money. They're going in with a loan, 5, 10% down and all that, and they're getting kicked to the curb on every offer they have, but their parents or their in-laws or someone they're related to has all these cash assets, and it seems like cash offers seem to be king in this market. Could you explain what delayed financing is to our consumers?
Absolutely. So there is a guideline on a conventional loan from Fannie Mae that states that if you pay cash for a property, we can refinance you within 6 months of purchasing the property and give you up to 80% of what you paid for the house back in a mortgage. So we have actually seen this used fairly frequently these days, where mom or dad or a family member will pay cash for the house, and then we just need to do the refinance to repay the parents or whomever for what they contributed so somebody could purchase the house. So that is definitely an option. There's 2 ways to handle it, though. If the buyer is on title and on the purchase agreement, then we have to treat it like a refinance. I have also seen situations where mom and dad buy the house for cash and turn around and sell it the day they close to their adult child.
So
and then we can do that as a purchase, it doesn't fall under that delayed financing rule. You can actually do a family member purchase to purchase transaction in that case.
Okay, and then when it's family member to family member, there is no transfer taxes paid, so that's a bonus there.
Yes.
But now let's walk through that example, because there's 2 ways, and I like the latter way there, that mom and dad come in, pay cash for the property, and they sell it to their to the purchaser, their family member, right? They can do max financing. They could give a gift of equity of 3, 5, 10%, 20%, correct?
Yes, they could.
You know, and then let's talk about the other way. The first way you described is that mom and dad pay cash for the property and they put the buyers on title. So now it's treated as a refinance because if you're on title, you can't buy something you already own. You technically own it. And you would be able to pull out up to 80% of the value. So that'll keep you in a 20% equity position without that PMI or private mortgage insurance, correct?
Correct. That is correct.
Yeah, I've seen that. I've actually had a client utilize that strategy. They lost out several offers. Then mom and dad come in and said, look, we're just going to pay cash. We're going to pay cash and help you out. And then we did delayed financing on a VA loan after the fact. And it just worked out beautifully. And it finally got them to the closing table.
Yeah. I mean, it's crazy. And not many people have that option, but sometimes they do. But here's what I would tell you. If you think you're going to go that route, consult with your loan officer first to make sure A, they're ready, B, all the numbers make sense. Because sometimes it would be better for mom and dad to buy the house and keep it in their name. And again, it's not going to be in their name for more than 30 days. Right. So it's not like there's a huge amount of risk, but there are potential tax implications. So, for instance, if parents have questions on those things, they might need to talk to their financial advisor and their CPA just to make sure they have all of their bases covered with whatever their financial portfolio looks like or their tax situation.
But it's utilizing all these creative strategies. I mean, I know you do, and I do have clients come in, and when we go through our discovery phase, how much you got in assets? Well, I got X amount of dollars. Well, do you have a 401k? Well, yeah, I do. Well, can you touch it? Can you take a loan or are you eligible for withdrawal? I don't know. I have to check. Oh, have you moved from another company? Do you have an old 401k, which is now a rollover IRA? Do you have access to that money? Oh, but I'll get taxed on it. Well, why don't you go ahead and roll that IRA into your current company 401k and see if it would then be eligible for a loan so you have no tax implications. Oh, I never thought about that. What about the gift from mom or dad? Is there any potential there? I don't know. I've never asked them. And that's why it is so important for people to get with your loan officer, sit down, understand, turn over every rock and get the cards on the table to understand what cards, not that we got to play them, but understand what cards are available so we can determine what cards we have to play under that particular offer, under that particular seller, under that particular situation to put you in a winning position.
Absolutely. Yeah. And I would prefer a client have more than one option, right?
Yeah, absolutely.
I love plan A, plan B, plan C.
Because you and we can sit there and give an option of what we think from outside the box, sitting there for an hour with the client. But these clients have several years of life. We need to understand what's important to them, what makes them tick. How can we help them to get their needs, wants, and desires? We need to understand everything to properly advise so we can report to the realtor of here's the strategies on plan A, plan B, and plan C. So we all look for the best interests of our client moving forward.
Exactly. But then you end up helping more than one person because, that person that is retiring and wants a condo is going to be really, really happy. And the people that buy their house are going to be absolutely elated.
Yeah.
And I've seen a few people sell their house and rent before they buy.
Right. Well, here, let's go down that rabbit hole. Danielle, go ahead.
Yeah. Well, if somebody's really concerned about it, they could sell their house and do a short-term rental situation. Now, I'm not saying that's easy. You're moving more than once, but for some people, if they can't kind of stomach the stress of buying and selling at the same time or buying first and then selling, I've seen that work beautifully too. And, I had a client who did just that. She lived in downtown Brighton, had to get some work done to her house. She worked really hard. got her house on the market. At the same time, I think she had a parent pass away, had to deal with all that estate stuff. And she just said, look, I'm selling the house. I'm going to move into an apartment for less than a year, and then I'll find my condo. And it worked out beautifully for her because she was able to take it at her own pace, felt very comfortable because she had the equity out of her home. And guess what? She bought a house, I think, in December. We just closed her within the last 3 or 4 weeks. So what are we in now? It's March. She, I think, bought in January, which worked out to be good for her because guess what? There was a condo, came on the market, and, you know, she was able to literally jump right on it. Not that that's right for everybody,
Right.
but, you know, that could be an option for some.
Well, I see that as a stress reliever because, you know, you and I do this every day. This is nothing stresses us out, it seems like. Well, not that we don't get stressed out, but
yeah, we get stressed.
We understand the game. But a potential seller may say, you know what? Let's take care of 50% of the problem. Let's sell my home, get my money, pay off any additional debt, rent temporarily, let the dust settle and reassess my situation, what my new options are, so we can go in and execute with precision.
Right. But if that's right for you, then there's nothing wrong with that, correct?
Yeah,
sometimes
absolutely.
People live with family,
well,
you know, they go, okay, we're going to live with family for a little bit. And
you know, and that's a great point because the rental market, of course, rents are going up. That's even the availability of rentals. So I want the consumers to consider, if you are thinking of selling, do you have a backup plan if there's nothing on the market? Could you discuss with family? Is there a potential interim place that you can go so we can get you the top dollar for the home, pay off any additional debt that you may choose to, and position you to now be a very strong buyer so you can compete with everybody in the market? That's a really good strategy, I believe.
Absolutely. And you know, the amount of equity that people are pulling out of their homes these days gives them a lot of flexibility to cover all that ground.
Absolutely there.
And plan it well. That's why sitting down, face to face, Zoom call, something of that nature. It's not just a pre-approval. You're not just looking for an interest rate and closing cost. This is big picture financial planning that you should be able to execute, and it makes you feel more confident.
Well, let's talk about that, about interest rate. And people are interest rate conscious, but when we are in a position where we need to sell, we're not rate conscious. We're objective conscious. And regardless if rates were 10% or 3%, 6%, it doesn't matter.
No.
Because your needs don't change. I need to upsize. I need to downsize. And we're just going to give you the best options that the current market can deliver to meet your objective.
Correct.
Yeah. It's interesting out there. Hey, let's talk about interest rates in the market. You know, I've been watching the market a lot. What's your take on interest rates? They're up, they're down, they're crazy right now. What's going on there?
Well, it is crazy. So we know, I mean, if we kind of recap the last 2 months, the Feds have been talking about raising the prime lending rate, trying to curb inflation. So that has been the major U.S. and world economy. And then 8 days ago, Russia invades Ukraine. Now, they've only been talking about this since, honestly, October. This has set the markets in another tailspin because stock markets across the world are being disrupted by this war event. So, yeah, the U.S. bond market is swinging like a pendulum. One day it's up, the next day it's down. We'll see where things settle down. I mean, it may curb a little bit the interest rates going up, which ultimately negative economic news is usually good for the U.S. bond market, which means it's good for buyers that are trying to get into homes or people that will still need to refinance. So I don't know. I left the magic 8 ball at the office. Don't have a crystal ball.
So it's in my office right now.
Is it in your office?
Yeah.
So you're gonna have to ask.
I'm trying to figure out what's going on out there, you know.
So maybe we need to bring the magic 8 ball to the podcast next week.
Maybe we should. We'll answer everybody's questions right there.
Yeah.
Yeah, because we're all gonna need a bigger magic 8 ball is what we're gonna need here, you know. But hey, let's talk. You brought up the Fed's rate. You know, explain to our consumer, the prime rate. Oh my God, I heard they're gonna raise the prime rate by 0.5%. Does that mean rates are going up by 0.5%? It is short-term lending. Please explain to our consumer your take on the federal rates.
So the federal funds rate is the rate that the Treasury borrows money to the banks. Okay, and there is also a prime lending rate. Those are all tied to short-term lending type products, which would be revolving credit cards, car loans, RV loans, boat loans, home equity loans, things of that nature, where you're only borrowing money for a couple of years.
Okay, so so on that short-term lending, the credit cards and all that. So if those rates go up 0.5% or 25 or 1/4%, what that means is it's going to get more expensive to use your credit cards, your auto loans, and all that, ultimately driving inflation up. And the reason they're doing this is they are driving those rates up to try to slow down the economy and all of that, because we're at what, 7.5%, an all-time high.
Correct. So the big thing for consumers to try to understand is that the government raising the prime lending rate does not directly impact mortgage interest rates. Our mortgage interest rate market is tied to mortgage-backed securities that trade, out there in the markets, like stocks do. Okay, or in bonds. It is mortgage-backed securities are bonds that any investor can buy, and they are in all of our retirement portfolios and things of that nature with our 401ks and
they are considered one of the safest investments, because a mortgage-backed security means it is a security, a stock backed by real estate.
Correct. And that's why we have guidelines to follow, right? Because we want to make sure that the bond market is strong so that people are willing to invest in it. And that's what keeps our interest rates low. Sometimes when the government raises that prime lending rate, it will settle the bond market down. And what we've been seeing the last couple months is the anticipation of, is the Treasury going to do a 0.5 point raise in March? Or is it going to be a quarter, right? Traditionally, we see 1/4 point raises. Because of inflation, they're more concerned. They've been talking about a 0.5 point raise. So this week, what happened was it yesterday? The Treasury said, we're probably not going to do a 0.5 point in March. We'll do a 1/4 point increase until things settle down in other parts of the economy.
Yeah, so, or the world. I think if we just got freaked out because of Ukraine. Now, if they freak us out with a 0.5 point, I think they're gonna ease into it. But I understand, or at least the word on the street is they could have several of these rate jumps over this next year.
True. Yes, there absolutely will be. But again, that doesn't necessarily translate to the mortgage interest rates at all. So don't panic. If you are in the market to buy, get out there, find your house. Try not to be too interest rate conscious. You could always refinance in a couple of years if the rates come down. But, I think we had talked about this before. My first interest rate in my first house was 10.5%.
Yep, absolutely.
My second house was 7.5%. Yeah. So anything under 5.5% is absolutely amazing. So, here's what my big takeaway for 2022, and it's only March 3rd, is...
And you're already wrapping up the year, throwing in the towel.
No, I'm not wrapping up the year. No, I think everybody needs to read something up on history, okay? Yep. If you don't understand the history of our country or our world, none of what we're going through right now is going to make any sense. So study the U.S. economy. You could go to the library. I'm sure you can find something online that you could read about the history of the U.S. economy, what recessions normally look like. They certainly were not all like 2008. We are likely to hit a recession in the next 12 to 18 months, but that doesn't mean it's necessarily a bad thing. Study world history, study Russian and European history, and you can kind of then try to understand how important these things in our world that are happening right now. I told somebody the other day, I said, my God, I never thought in my lifetime I would ever think that I was lucky to grow up in the Cold War.
Really?
Okay.
That's me.
Yeah, that's a lot of us, right? In our generation. And you go, well, the Cold War ended in 1989. So anybody, which is all our kids, all these millennials, if they didn't study history, they don't understand this. And, I don't know. You got to look at it. The whole Russia thing, that's been going on for decades and decades and decades. And, this was like our biggest fear as kids, right?
Right.
And I think that what's going on in Ukraine is extremely serious, and it could have long-term implications for the world, because I'm not sure, not to be, I don't know. I who knows what's in Putin's mind right now?
Yeah.
Attacking a country that he just wants the real estate on. You kind of had hoped since World War II we got behind some of that.
Yeah. Hey, you brought up the rates again. Right now, interest rates are, 4.25%, right? And Americans have short-term memories. They're all still thinking of where we were 2 months ago at 3 1/8 and 3%. I'm going to hold off for lower rates. But when we look at history, as you just brought in, let's just look here in March of 2022. We are still below, a little bit lower on our interest rates than we were just pre-pandemic, So this was just a few years ago we had this environment. And of course, the pandemic is bad, or, as negative impact it had on the market. That was a blessing in disguise for a lot of people that were able to take a refinance opportunity and purchase. But hey, people, we're just getting back to normal rates of where they were a few years ago. So let's, put our tail between our legs, wipe it off. Let's move forward and get you in a position to execute on a purchase if that's what you so desire.
Yep. In 2018, our rates were probably between 4 and 4.5%, as I recall. So, this is still a great market. I promise you, if you buy this year, you're going to look back in a year and go, oh, thank goodness that we bought.
Yep, they were right. Yeah. Yeah, my first home, $343 a month house payment. Now my cell phone bill's double that. And I thought, how the heck could I do it? But
it's crazy.
So let's wrap up the show here, Danielle. What is your words of wisdom to our potential sellers and our serious home buyers out there?
Folks, get your running shoes on. It's going to be a very, very busy spring and summer season. I think it's actually going to be a great year in real estate, particularly in Michigan. But get ready, be prepared, and understand what your options are. And you'll get to the finish line sooner than you think.
And if anybody wants any advice or to talk, just go to DanielleBoote.com or VictorBals.com, and we would love to help you out. And from Dallas, that is Mrs. Danielle Boote. I am your host, Victor Bals, and we will see you next time on A Smarter Way Home.